A financial crisis isn't just random chaos. Think of it more like a script. It often unfolds in 5 stages, where the order of events is common even if the exact timing changes, and the stages themselves can blur. Certain things tend to break in a specific sequence. The bond market almost always whispers the first warning, long before the stock market starts screaming. So, what if you could learn to read the signs? Not with a crystal ball, but with a blueprint that most people never get to see. What if every major meltdown, from the Great Depression to 2008, followed a surprisingly similar pattern? Well, that blueprint is real. For decades, top economists and legendary investors like Ray Dalio have seen the economy as a kind of machine. And like any machine, it has cycles, it has stress points, and when it breaks in a sequence. As a quick recap, our 3 warning lights video covered the what: the yield curve, credit spreads, and liquidity stress. This video is about the how, the sequence in which those lights tend to flash. The problem is, most of us only tune in for the final, explosive stage: the stock market crash, the mass layoffs, the panicked headlines. By then, it's way too late. You're just reacting to the noise. The real story started months, sometimes even years earlier, in the quiet, methodical corners of the financial world that most people ignore. This isn't about scaring you, it's about preparing you. Understanding this timeline is the difference between being a victim of the economic cycle and being a student of it. It's about knowing where to look for that first hairline crack, so you're not shocked when the whole wall comes tumbling down. We're going to walk through the anatomy of a crisis, from the first quiet signal to the chaotic fallout, and finally to the government response that sets the stage for the whole thing to start over. By the end of this, you won't just understand the last crisis better, you'll have a framework to see the next one more clearly. Every crisis usually begins not with a bang, but a whisper. And that whisper almost always comes from the single most important, yet most overlooked part of the financial system: the bond market. Specifically, a strange phenomenon called the inverted yield curve. Now that sounds technical, but the idea is actually simple and incredibly powerful. Normally, if you lend money for a longer time, you expect a higher interest rate, or yield, because there's more risk. A 10-year government bond should pay you more than a 2-year bond. Simple enough. That makes for an upward sloping yield curve. But sometimes, the curve flips upside down. The yield on short-term bonds, like the 2-year Treasury, rises above the yield on long-term bonds, like the 10-year. This is the bond market's giant flashing warning light. It's thousands of the world's smartest investors all making the same bet. They believe the economy is heading for a slowdown so severe that the Federal Reserve will have to slash interest rates in the near future. They rush to buy long-term bonds to lock in today's higher rates before they disappear, which pushes those long-term yields down. This isn't just a theory. It's historically one of the most reliable early recession signals we have. But the timing can be messy. Since the 1950s, most U.S. recessions were preceded by an inverted yield curve, which typically flashes its warning signal 6 to 24 months before the recession officially hits. For example, parts of the yield curve began inverting intermittently in 2006, well before the 2008 crisis became obvious to everyone. The curve inverted way back in July 2022, and as of late 2025, an official recession hasn't been declared. That doesn't mean recession is guaranteed, it means risk is elevated. This highlights a key point. The signal is about rising risk, not a calendar date. History shows the lag can be long and unpredictable, but it suggests trouble ahead, making it the crucial first stage in our crisis script. To see this in real time, you can watch the 2s 10s and the 3 M10Y curves. This is the first and earliest signal to watch. And if you want the exact 3-light dashboard, watch the 3 warning lights after this. If the inverted yield curve is the silent alarm, this next stage is when the system's plumbing starts to spring serious leaks. This is where the crisis moves from a prediction into a real, tangible problem in the credit markets. It happens in 2 parts. widening credit spreads, and a liquidity squeeze. First, credit spreads. That's just the difference in interest rates between a risky bond, like from a struggling company, and a super safe government bond. In good times, that spread is tight because everyone's feeling optimistic. But as the fear from the bond market begins to spread, lenders get nervous. They start demanding a much higher interest rate to lend to weaker companies, and the credit spread widens. This is a quiet panic. The cost of borrowing for the most indebted companies starts to skyrocket, putting their entire business at risk. As the economist Hyman Minsky described, the economy moves from a stable phase, where everyone can pay their bills, into a shaky one where companies are just borrowing to pay off interest. Next comes the liquidity squeeze. Liquidity is the grease that keeps the financial machine running. It's the ability to get cash fast. As fear grows, that grease dries up. Banks get suspicious and stop lending to each other freely. The repo market, a critical market for overnight loans between financial institutions, can start to seize up. We saw a version of this during the regional banking mess in 2023. When people rushed to pull their money from banks like Silicon Valley Bank, the bank had to sell its bond holdings to get cash. Because interest rates had gone up, those bonds were worth far less than what SVB paid for them, creating massive losses that fueled the panic. It wasn't a total system-wide freeze like in 2008, thanks to the Federal Reserve stepping in with emergency lending programs. But it showed how quickly confidence can evaporate and how liquidity problems at a few institutions can threaten to spread. This is the financial system gasping for air, the final warning before the crisis explodes into public view. To track this, watch high yield spreads and signs of funding stress. This is the part everyone recognizes. This is the main event. While the bond and credit markets were sending subtle warnings for months, the stock market is where the crisis becomes an emotional, public spectacle. If the yield curve was a whisper, this is a scream. Stock prices are driven by two things: earnings, how much money companies make, and the multiple, how much people are willing to pay for those earnings. In a crisis, both collapse at once. The economic slowdown that the other markets predicted finally hits company profits. Then, fear takes over. The optimism that justified high prices vanishes overnight and is replaced by raw panic. A downward spiral begins as forced selling kicks in. The stock market crash is often a lagging indicator. It's less of a prediction and more of a loud, violent reaction to the problems that have been building under the surface. By the time the S&P 500 is down 20 or 30%, the crisis is no longer a forecast. It's a reality. This is what economist Hyman Minsky called the Minsky moment, the point where everyone realizes the assets they own are wildly overvalued, and the house of cards collapses. We saw it with tech stocks in 2000, and with housing in 2008, when people were convinced prices could only go up. The stock market crash is the brutal punctuation mark at the end of that speculative fever. And it's the moment the crisis officially jumps from Wall Street to Main Street. The key metrics to watch here are negative earnings revisions and forced selling events. This is where people get destroyed emotionally. That's why you need to watch 5 mistakes investors make when recession fears rise. This is the most painful stage. This is when the abstract numbers on a screen turn into real human suffering. The real economy, jobs, small businesses, household savings, is the final and slowest domino to fall. Financial markets can crash in weeks, but the fallout on the real economy unfolds over months, sometimes years. The first sign is layoffs. Companies with falling profits and high borrowing costs start cutting staff to survive. The unemployment rate, which is a lagging indicator, starts to climb. For instance, after the financial stress of 2007-2008, the US unemployment rate didn't actually peak at 10% until October 2009, long after the worst of the market panic was over. This is a key takeaway. By the time you're seeing for lease signs all over your town, the worst of the financial crisis has often already passed. The National Bureau of Economic Research, NBER, the group that officially calls recessions, often doesn't make the announcement until months after the recession has already begun, because they wait for hard data on jobs and income. From here, a vicious cycle kicks in. Job losses lead to less spending, which causes more businesses to fail, which leads to more job losses. People feel poorer from the stock and housing market crashes, so they save more and spend less, shrinking the economy even further. This is when public anger boils over and people demand that the government do something, which sets up the final stage. Here, you'll want to watch the unemployment trend and consumer loan delinquencies. Right when it feels like the economic collapse will never end, the final stage begins: a massive government response. Central banks and governments, which were often slow to react, finally unleash everything they have to stop the bleeding. This response usually has three parts. First, for major economies like the US, central banks slash interest rates, often down to zero. The goal is to make borrowing cheap again to kickstart spending. Notice this brings us full circle. The inverted yield curve at the start was predicting these very rate cuts. Second, the government steps in with fiscal stimulus. This could be bailouts for key industries, like the banks in 2008, or direct checks sent to citizens, like in 2020. It's a direct injection of cash into the economy. Third, and most powerful of all, is quantitative easing, or QE. This is a fancy term for when the central bank creates new money to buy financial assets, like government bonds, on an epic scale. While often simplified as money printing, it's technically an asset swap that floods the banking system with liquidity, pushes down long-term interest rates, and nudges investors back into riskier assets like stocks. If you want the real why markets rebound while life still feels awful, that's liquidity in the macro masterclass. This overwhelming policy wave is what usually marks the bottom of the market. The great irony is that the absolute best time to invest is often when the economic news is at its absolute worst, because that's when the policy response is at its biggest. This is the moment the yield curve becomes very steep again. Short-term rates are pinned at zero, while long-term rates start looking toward future growth. Key signals here are Fed liquidity injections and major fiscal response packages. And that very intervention sows the seeds for the next cycle. By making money cheap and encouraging risk-taking, the rescue from one crisis creates the perfect environment for the next one. And the whole five-stage play is ready to begin again. So if you want the simplest possible cheat code for the sequence, here it is. Bonds first, credit second, stocks third, jobs last, and policy last. That's the progression from the first whisper to the final reset. This is educational, not financial advice. Always seek professional financial advice for your specific situation. So there you have it, the 5 stages of a financial crisis. It starts with the bond market's whisper, moves to the credit system's cracks, then the stock market screams. After that, Main Street bleeds, and finally, the cycle is reset by a massive policy response. Understanding this script doesn't mean you can predict the exact day a crisis will hit, but it does give you a roadmap. It tells you where to look and what to watch for, so you can see past the panicked headlines and understand the mechanics of what's really going on. If you found this breakdown useful, comment timeline below, and I'll drop my one-page crisis checklist directly to you. It's the timeline cheat sheet we just covered, combined with the 3-light dashboard, all in one place. Thanks for watching. Next video, we build the next layer of the plan. Watch the plumbing, not the headlines.